Hi everyone, it's Krista here. Thanks for tuning in. There's been a lot of buzz in the market lately about how volatile the market is, even though the stock prices are going sky high. And in this type of environment, sometimes what investors would like to do is invest in a lazy portfolio. So what is a lazy portfolio? Well, interesting that you asked that question. I actually was wondering this myself. I was looking on the internet to try to find investments to purchase during this really crazy market environment, and I came across the All-Weather Portfolio by Ray Dalio, a hedge fund manager, and apparently he's in cahoots with Tony Robbins, who's written a book called Mastering the Money Game, 7 Simple Steps to Financial Freedom, where Mr. Robbins talks about Ray Dalio and his all-weather portfolio, which is designed to perform fairly well in all types of market conditions, regardless of what the market is doing or even the value of the almighty dollar. And this portfolio consists of a stock market fund, a bond fund, plus gold and commodities funds. Personally, I'm not a super big fan of gold and commodities. Gold is actually trending right now. It's getting to be more popular, maybe because of the market conditions, but it's not like you can just go to the grocery store and put a big gold bar down on the counter to buy your groceries with, or you can't will a bag of rice through cyberspace to complete your Amazon order. So I went searching a little bit more, and I found a book called How a Second Grader Beat Wall Street by Allan Roth. And I purchased this book. I downloaded it onto my Kindle because I figured if a second grader can do it, hopefully maybe I can do it too. So Allan Roth, I think he's a financial advisor, talked about a portfolio that his 7-year-old son set up. I'm sure he had something to do with the fact that his son set up this portfolio. I don't think it was all his son's idea, but it consisted of 3 funds. One was a total market index fund, a total bond fund, and an international bond fund, and how that combination outperformed the managed funds by a variety of analysts on Wall Street. He also talked about how difficult it was to choose stocks and to predict markets, and this is something most analysts will tell you, regardless of their experience. There's really no way to predict the market. I mean, there's all kinds of things to look at, but nothing predicts it for sure. The 7th grader portfolio book was a very good book. I thoroughly enjoyed it. The only thing is that I also like REITs, and I think if you had looked at my first video on the stock analysis of Tractor Supply, and I can link that video in the show notes, I do mention how much I do like REITs. Real estate investment trusts are traded on the stock exchange just like stocks. However, they are a little bit different. They are required to pay 90% of their earnings in dividends, so it's a fairly large dividend, and those dividends are treated as income instead of capital gains like the dividends in the stock market. So there is a little bit of variation on how they are treated for taxes, and for that reason they're often kept in tax deferred accounts like IRAs or Roth IRAs. The other thing with REITs is they don't totally match the economic conditions of a stock fund. They mitigate the risk a little bit for the reason that real estate is a little bit more a stable investment. So for instance, if Walmart has a bad quarter, they're not going to vacate their premises and give up their lease. They're still going to keep that lease and still going to keep their building, and they're still going to pay their rent to the company that gives them their lease. And I think in that respect it might be Spirit Realty. They are a REIT and they do a lot of commercial real estate. Eventually, if the economy goes really bad, a store may give up its lease, it may have to fold, and then that property will be vacant and Spirit Realty will not be getting any money either. But usually there is a lag time between the time that a cyclical stock does bad in the market and a real estate investment trust does bad in the market. So for that reason, I like to keep real estate in the mix as well. There's a whole variety of lazy portfolios, and in its basic fund form, you can have just one fund as your lazy portfolio, and that would be something like a target date fund or a life cycle fund. And in those cases, there is a date somewhere in the future which is projected where you're going to be drawing out your investment on those funds. So for instance, if you're planning to retire in like 2025 or later, 2030, the fund is gauged so that you would have a higher percentage of stocks the further away from that time period you are, and a lower percentage of bonds. And as the time grows closer to your target date, you would get a higher percentage of bonds. So bonds are a more stable investment. Usually they grow at a slower rate. As you get closer to your drawdown date, you're going to want to have a asset class in that mix that does not grow as fast but is more stable. And these are typically managed funds, so usually you have an expense ratio that's higher than the index funds. So after a one fund portfolio, then you have the two fund portfolio, and that's usually a mix, like an index fund mix of a total world market fund, like maybe the Vanguard ticker VT, and a total bond fund like the Vanguard ticker BND. And again, you can tweak these percentages to be as conservative or aggressive as you want. So if you're very aggressive, you might have 20% bonds and 80% stocks. And if you're more conservative, you might have 50% bonds and 50% stocks. Then after that, we have the three fund portfolio, which is your second grader portfolio, and that adds the international stock fund into the mix. And then if you want to add a read-in, you would get something like Rick Ferri's Core 4 portfolio. Rick Ferri is a very prominent advocate of the Boglehead Site, and he actually runs a Boglehead podcast. So there's a variety of asset classes and flavors that can be included into your lazy portfolio, and you can have everything from a total stock market fund to the S&P 500 market fund to emerging funds to international market funds to a total bond market fund to inflation protected bond funds to municipal bond funds where you would not need to pay taxes on the dividends, to international bond funds, to gold, to commodities, and the list goes on. You can have just about any type of asset class in your lazy portfolio, but just keep in mind that the more assets that you have in your portfolio mix, the less lazy and more complicated it becomes. And there's a variety of informational sources that you can look at to find out about these portfolios. There's the internet, there's a ton of books on lazy portfolios, but one of my favorite sites, of course, is the Boglehead Site, which I'm going to go onto the computer and we'll look a little bit through the Boglehead Site. Okay, here I am in the Boglehead wiki site, and I have information here on lazy portfolios, As you can see, there are a combination of portfolios on the site. We have both the mutual fund symbol as well as the ETF fund symbol. We have 2 fund portfolio, 3 fund, couch potato, Rick Ferri's 3 fund, core 4, Coward's portfolio, coffee house portfolio. There's just a variety of portfolios here. I do like this David Swenson's lazy portfolio. This is also called the Yale portfolio. I have it as part of my portfolio in my M1 Finance app, and it performs fairly well. If you wanted information on M1 Finance, I do have a link, an affiliate link down in the show notes. So feel free to click on that. I believe you can get some information on the M1 Finance app. It's a great app, and it puts all of your financial information into pies, which is very useful, kind of like these portfolio pies. This is the permanent portfolio, which consists of a large percentage of bonds and gold, and it's billed as a very established, stable portfolio. Now, at the very bottom of this site, we have some more information. There's a link on how to build a lazy portfolio, and how to build a lazy portfolio right here. And then we have some information on portfolio return data. I do like this one from the financial page, which is a Boglehead blog, but it's an unofficial blog. So if I click on that, you have the performance of several different lazy portfolios during 2019, the Coward's portfolio, the Yale. We can look at this. Let's take a look at this for an example. And you see how this portfolio performed during 2019. You've got the various expense ratios associated with it. There's a lot of information on the site from the wiki site as well as the financial page, the unofficial blog. So there you go for the Boglehead site. The other very useful site that we have is a Marketwatch site, which I will also look at on the computer. And in that case, it compares the growth rates of each of various lazy portfolios with the S&P 500 over time. Now keep in mind, since the S&P 500 is solely a stock asset class, it is going to outperform any of the lazy portfolios over the long run. However, you have an increased component of risk because there's no bond asset classes or anything else to mitigate that risk. So when it comes to your investments, you might want to be less greedy in the seeking returns department in lieu of sleeping well at night and ensuring that you're going to keep much of your portfolio and that it won't completely disintegrate in value if the market tanks. Okay, so here we are in the Marketwatch site. This is a very tidy little lazy portfolio site. You've got the total returns for 8 types of lazy portfolios here, 1 year to 10 year, and it compares it with the S&P 500 as a benchmark. Obviously, the S&P 500 is higher because they don't have the bond stability in that ETF. If I go into each one of these, This is the Dr. Bernstein Smart Money portfolio. You've got all the various components here of the portfolio. There happen to be all Vanguard funds. And the allocation and the returns for each one of those components. And again, you have it compared to the benchmark of the S&P 500. They also have a little toggle switch up here. And you also have information on how to create a lazy portfolio. If I go into the toggle switch, we'll pull up the coffee house here. And again, I have all the various components, and they all happen to be Vanguard funds. You don't need to necessarily choose Vanguard funds, Schwab's. There's other types of index funds that you can choose for your portfolio. We have the returns and the allocations for each of those components. And again, we compare it to the S&P 500, which is always going to have higher returns. But keep in mind that the S&P 500 is a much more volatile index than your portfolio returns because you don't have the bonds factored in. So that's it for the Marketwatch. I'll go back to the main screen here. And that's it for the Marketwatch. And we'll go back to our regular broadcasting. So there you have it. That's basically our discussion for today. And if you like this video, be sure to hit the like key. And if you would like to see more videos like this, you can subscribe to my channel, so hit the subscribe key. And if you would like to be notified every time I release a new video, please hit the bell. And stay tuned because I plan on launching a video in the near future on a modified lazy portfolio where I will use the M1 Finance app to add greater positions of some of the popular stocks right now, like Microsoft or Apple, to the asset classes of my lazy portfolio to just add a little bit of variety into the mix and allow me to follow some individual stocks or REITs as well. So that's it for now. Stay inspired, and I am signing off. Bye.